From the morning reading, the Qs, Facebook, and Microsoft new all-time closing highs. 8 of 10 sectors moved higher on Monday. XLK, XLY, and XLP were the strongest sectors, while XLE was the weakest sector. XLK moved from neutral to uptrending sector with today's action. Oil futures fell 51 cents to close at 50.49. Breadth strengthened compared to the prior session as advancers led 1803 to 1218 on the New York Stock Exchange and led 1649 to 1089 on the Nasdaq. Mega mergers have been announced at a brisk pace. There are many reasons besides a welcoming market why large mergers can be announced, but whatever the reason, they've been popular lately. The proposed marriage between AT&T and Time Warner boosted the 6-month total value of announced deals to over $500 billion for the 5th time in the past 20 years. The Dow has been struck between trends for over a month. The venerable Dow Jones Index has been trapped below its medium-term 50-day average and above its long-term 200-day average for more than 30 days, causing traders and investors to wonder which trend is more likely to enforce itself going forward. Going back to 1897, there's been a baker's dozen of similar situations, usually leading to decent medium-term returns. Sellers keep coming into the market in the closing minutes. For almost 2 weeks, sellers have appeared during the last hour of trading in stocks. Based on the smart money theory of when participants place trades, this should be a negative for stocks. Indeed, after a few times stocks have been sustained last hour selling pressure, stocks did stumble going forward while doing well after multiple days of last hour buying. There has been a big shift into funds betting on volatility. On Friday, there was the biggest move into long-term volatility funds versus the short volatility funds since 2013. These are usually smart money traders, but we prefer to look at this flow with a 20-day average, which has been an almost perfect indicator for years. On that basis, the past 20 days, the indicator is just starting to near an extreme and isn't quite to the levels that precede a decline in stocks in recent years. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:14 a.m. Mountain Time, and I am recording this in preparation for the market day of October the 25th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report, which I forgot to pull up. Give me just 1/2 second. And this really won't take but a moment. Sorry about that. Get these sized properly for you. Now you can read them. You see part of what goes on behind the scenes and getting ready every day. Okay, so the morning report. At the time of this cut, you see that the 4 U.S. broad-based indices were all just above scratch, so nothing significant going on in any of the 4. Crude oil's also just above scratch. The euro's down just below scratch, as is the long bond. And then the gold is up about 0.5%. In terms of overseas action from our most important trading partners, China up just above scratch, Hong Kong just below scratch, Japan up about 0.75%, Germany up about just under 1/3%, United Kingdom up a little more than 1/3%. In terms of macroeconomic reports of note for today in the United States, you have consumer confidence. And looking forward to tomorrow, you have new home sales and the weekly crude oil inventories. So a little bit of action, not too much. In terms of current volatility conditions, Short-term VIX down to an 11.35 skew, still benign, below the 125 threshold. And then the IV percentiles are all in the lower 25 quartile. The S&P at 21, the Russell a 15, the NASDAQ a 15, and the Dow a 22. Very, very low volatility at this point. And if you look at the last two rolling trading weeks, we've only had in the last 9 days just one event where we had a standard deviation size move, and that was yesterday with the NASDAQ. So very, very low activity of recent trading. In terms of the charts, let's go ahead and start with the S&P futures. And you see we're starting to set up for a potential cloud breakup. Now, we've been in this very sideways action for multiple weeks now, with a little bit of a challenge to the top side and a challenge to the bottom side, but support, key support, holding by the bulls here about a week and a half ago, and it's been just slowly moving itself up with a lot of spinning tops and doji type candles. Just very, very, very slow energy move to the top side. Overall, though, while we're apparently breaking through the cloud today in price action thus far, we haven't seen the cash participants yet, but thus far slightly up and over the cloud. You still have to put it in context that we're still just in the middle of the recent trading range, and this is a still very finely balanced price action pattern. So you could probably argue that we're starting to break out of a near-term, short-term or resistance, I should say, and then coming back up here into the prior range, and need to challenge this. I suppose you could draw a little bit of a diagonal resistance across here. Let's see here. So that would seem to say that we're right up against that. I think, frankly, more important, and the reason I hadn't already drawn it, was I think the horizontal support is going to be more important. So until we get above 2175, a lot of overhead resistance in play for the S&P. We get above 2175, we probably challenge the all-time highs at that point. And then Dow's been in very much the same pattern. And you see it's just kind of been also after kind of going after key support has been in this kind of shallow bias to the bullish side, but with a lot of indecision candles along the way, and is in also a finely balanced area. In terms of the NASDAQ, now the NASDAQ had some more interesting action yesterday, and you see that it broke out of its pattern and actually set a new closing high yesterday, and then last night a new intraday high on the NASDAQ. So price action has continued to be more bullish on the NASDAQ, and really, while we had a little bit of a flag pullback here, there was nothing that ever got terribly scary, never had a close even in the cloud. And then on the Russell, of course, had been with the NASDAQ and being more bullish, but had deteriorated down into the cloud. And you see also, kind of like the Dow and the S&P, challenged the bottom of the key area of support and has been slightly bullish since, but in a very, very short-term pattern that's pretty finely balanced. So we got three indexes that continue to be in the very short term, just barely a little bullish, but in a bigger context, a very, very neutral and finely balanced patterns, with the outsider being the NASDAQ. In other markets, key action, of course, crude oil has been also trapped inside a relatively small range between a prior swing high and the prior swing high that was the all-time high. We had this little bit of a intraday swing that set a new intraday 52-week high, but that was quickly invalidated and back into the range. So that was a false breakout at that point. In terms of gold, gold has also been in a sideways chop. It just has been the story over and over again this year. Sideways, range action, finely balanced, all these words are just basically saying that the market is very neutral and not trending at this time. So as much as we like trending markets, we have not had it of late. We'll take a look at bonds. Bonds also in a sideways consolidation pattern. Lots of overhead resistance on bonds, so not going anywhere fast there. Of course, volatility has been falling ever since we had a bit of a spike about a week and a half ago, and right now action's below a 13, so getting remarkably low there, especially for an October. You know, often October is a seasonally kind of scary time in the markets, and this October has been clearly thus far absent of such action. Now, probably the influence of the election, and could see more of this sideways action until we start to see some resolution, especially to the House and Senate control, which seems to be the primary expectation of unknown out there at this point. Though some of the early balloting seems to be saying that this election might be closer in some key battleground states than maybe the polls had indicated. So we'll continue to see how the situation develops and how that then affects the markets. Thus far, the markets don't seem to be pricing any fear in, despite whatever variable outcome might be ready in a couple of weeks. It's not being priced into the volatility. People aren't buying puts or anything like that in anticipation of an outcome potential. So that would seem to be telling at this point. Okay, I think that's probably enough on the charts. Let's go ahead and go to the daily report. In terms of the market intermediate term phase opinion, still market phase 5, the break of diagonal support. We never did break horizontal support, so this has been relatively bearish market phase, and yet at the same time hasn't turned decidedly bearish. In terms of the three market timing opinions, the first one from IBD is uptrend under pressure, so that's certainly a warning sign there. GMI index hasn't been updated for a couple sessions now, but the last report we had was a 1 out of 6 with a sell signal in place since 10-12. Stock charts decision point scoreboard did have one change yesterday. We had one signal come in on the Dow with a short-term bullish signal, though we see obviously the consensus amongst all the others is that the short term is in neutral to bearish, and then also in the intermediate term, largely neutral to bearish, with the NASDAQ being still bullish. Long term on all the indexes is decidedly mixed. So when you put all this together, overall consensus right now is still slightly bearish, and yet perhaps some improving conditions, and but overall very, very neutral, and really difficult to kind of get any kind of headway to either side of the market. In terms of position sizing opinions, the portfolio model at 50%, the active trader volatility-based model at 75%. Overall market posture is a weak bull signal. This is an intermediate term, and this is then countered with a weak bear sentiment line. So very kind of weak influences coming from both directions, and again, that's what gives you these finely balanced markets. Though we do have to note that things have improved. We did have strong strong bear intermediate term market postures just a couple sessions ago, and not only have we flipped over to weak bulls, but we've also seen those scores improve. We were in danger of falling below a 20 at the end of last week, and we're now up in the 40 handle for the S&P and the Dow. The Russell just turned into a weak bull. NASDAQ, of course, a stronger bull at a 66. In terms of the strength of the trend, note that this has now fallen below an 80, so we're currently in a weak trending market. Hedge warning status has also changed for today. With the improving conditions, I have dropped it to level 1 plus, which is caution with some elevated conditions. So, of course, it's of note that when you are at 1 plus, which direction are you going? We didn't go from 1 to 1 plus here. We went down from 2 to 1 plus. So conditions seem to be, while still elevated, somewhat improved, and we have, as it were, backed away from the precipice. We came into that area a couple sessions ago of key support, I should say a few sessions ago, key support, and the bulls held that key support. So as it stands right now, support is held until it's not. And so far right now, the bulls are indeed showing that they can hold that key line of support. Now, in terms of the strategy opinions, we had some upgrade here as well, though still pretty cautionary. Option income strategies, the VIX is acceptable to initiate new positions for novice traders. In terms of covered calls, also borderline acceptable, and put selling borderline acceptable to initiate new positions for novice traders. Traders might want to consider a fairly defensive structure, 2-to-1 ratio of in the money versus out of the money strikes, and then also a 2-to-1 ratio of low beta versus high beta. So this is not, as it were, in the opinion, permission to just kind of jump all in, that all the water is crystal clear. The water is anything but crystal clear. We're in the middle of potential tide change, and the water is swirling, going in both directions at the same time, and things are quite choppy. Not a lot of tide current with any kind of strength going either direction is probably a best analogy at this point. In terms of specific warnings, you see we still have very low kind of activity coming from the volatility-based group, and with only this distribution day count on the S&P at a warning status. In terms of the trend-based, we have just this market phase 5. New York Stock Exchange new highs, new lows almost hit a positive level at 300. That would have been a strong signal for the bulls. In terms of the key intermarket risk aversion indicators, they're still all 5 as risk off, though several of these are quite tightly wound and could probably be better characterized as neutral. They're basically flat lines and on top of each other. So I could have called this risk off. I could have called it neutral. I could have called it risk on. Probably the best way to put this at this point is neutral to risk off until proven to be bullish. So I'm waiting for some angle and separation in those lines before I want to kind of give it the benefit of calling it risk on. In terms of sentiment, you see that everything's relatively benign across all 4 of those markets. Fear and Greed Index has improved in recent sessions and is now up in the neutral category. In terms of sector specific, you can see yesterday's action was pretty positive, and especially for information technology. Of course, the big merger announcement with AT&T and Time Warner, I assume that's this information tech area. Also, you see other largely, well, let's see. I'm trying to see if there's a statement here in terms of defensive areas. Here's utilities, real estate, consumer staples. So we've got a pretty good representation from the defensive sectors up here in the upper performers, but there's also, these consumer discretionary, information tech, these higher beta industrials, materials also represented. So it's actually a pretty good mix of high beta and low beta with the best performers. And then in terms of the healthcare and energy, here you've got some, well, these are relatively minor negatives, so we won't make too much of that. Telecom, of course, now AT&T is part of telecom. I'm assuming that Time Warner is up here in information tech, but I don't know that for a fact. But certainly Time Warner, as the acquirer, it's generally assumed that the acquirer pays too much And certainly this is a great big deal. I believe the number was like 85 billion that they have offered for Time Warner. In terms of other sector-specific information, you see the intermediate as well as the short and long-term market postures. And this is quite a rainbow right now with, it's very difficult to pull a lot of consistency out of here. We will say that financials has pretty much held up during most of this time as being up in all three time frames. So that's probably the one sector that has been the most consistent in recent weeks. You see the percent change for yesterday, and then for the 5-day has been fairly solid, though the 1 month and 3 months still quite negative for most of these sectors. Okay, I think that's probably enough for today. We're just gone a little bit over 20 minutes. So let's go ahead and wrap this thing up. I'll scroll through these slides. If you see something you need more information on or a hyperlink, just hit the pause button. And then we'll get to the disclaimers. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note that the hyperlink down here at the bottom will take you to the full set of disclosures. Of course, we should be back here tomorrow morning with the next market preview from Falcon Global. In the meantime, manage that risk and seek to go out there each and every trading day and learn something about your craft. Good trading.